Basically, the impact that we've seen has been on longer term rates and has not at all affected LIBOR, which is basically the primary short-term indicator. In fact, LIBOR, I believe, over the last month or 6 weeks, has even gone down at certain points in time, but it hasn't moved at all. You really have a situation that that nothing has happened necessarily except some conversation, and that's what's really moving the market right now. Rising interest rates always rattles people because it always forces them to think. Because we were in an environment where people took the norm as a long-term norm rather than a aberration. But it also has got some people who were just sort of deferring make a decision to make a decision, and that that's the flip side of sort of the coin of not sort of like having lower interest rates. The high interest rates, even though they cost more for people, they kind of create enforced decisions. Really, if you want a true fixed rate long-term loan on a nursing home, there's really only one place to go, okay? That's HUD. If you want a true fixed rate long-term loan on an assisted living building without a call provision, there's really only one place to go, and that's HUD. And Fannie Mae and Freddie Mac have been kind of, in that business substantially, in today's world, substantially reduced programs. But, their future is very unknown. I think they're going to just strongly continue with the programs, at least a majority of the programs over a short-term basis, because they are just totally focused on how they, kind of create job growth and economic growth. And, the fact is, in this, over the last 5 years in this, economic contraction, a lot of companies have figured out how to get by with less people and how to have more productivity within their framework.